Welcome to Close of Business. I'm Alicia Barry. The inflation genie is officially back in the bottle. The Reserve Bank's preferred measure of inflation has fallen to 2.4% in May, the lowest reading since November 2021. And that gives a green light on rate relief for borrowers, with the markets betting there's more than a 90% chance of another cut in July. Here's Emily Stewart.
With around 140 trucks, fuel is one of transport company Cold Express's biggest costs.
We'd go through hundreds of thousands of litres, on a weekly basis.
War in the Middle East has contributed to volatile oil prices.
When the fuel goes up, the price of goods in stores goes up because the fuel levy has to be added to the cost of getting the products to the store.
The fragile ceasefire between Israel and Iran has seen prices plunge.
Oil prices have come down very, very quickly, and so I guess what that's telling you is that any sort of risk premium that was priced into that market has now basically evaporated very, very quickly. It's telling you that the market's not that worried about any shocks to the supply side.
Back home, it's still tough at the Bowser.
Everything's going up, and it's just an unbelievable world we're living in at the moment.
So we live in Maningrida, which is about 6 hours away by car, and the petrol prices there are nearly $3 a litre, which is huge.
The price of fuel actually fell 2.9% last month and 10% for the year, helping to put downward pressure on inflation, which came in lower than expected at 2.1% in the 12 months to May. Food, non-alcoholic drinks, rent hikes and construction cost pressures eased. But gas prices did accelerate, while electricity prices went backwards. The Reserve Bank's preferred measure of underlying inflation fell to 2.4%, well within its target range.
This is the lowest that inflation has been for years. Well, I'm reluctant to say it's mission accomplished, but we are certainly making more progress than was expected.
A price war on home brand products in supermarkets is underway, according to JP Morgan. And Choice found a basket of 14 items was slightly cheaper at Aldi than Woolworths and Coles, but a lot more expensive at IGA.
I do find Aldi are a lot cheaper, but sometimes they just don't have the same things that Coles and Woolworths do have, so yeah.
Some relief could be on the way for households, with financial markets pricing in more than a 90% chance of an interest rate cut when the Reserve Bank meets next month. The softer than expected inflation figures are bolstering expectations of more rate cuts this year.
That probably means that they will cut in July, follow up with another one in August, and most likely deliver a third cut this year in November.
In time for when many households might need it most.
The inflation data forced Westpac to shift its call for the next RBA cut to July from its earlier view of August. Westpac's chief economist Luci Ellis joined me. Luci Ellis, welcome to Close of Business.
Thanks, Alicia. Great to be here.
What was it about the inflation data in May that had you switching your call to a likely cut in July?
It was about some of the detail in the inflation release. There were some categories that were lower than we expected, and they were the ones that have a certain amount of persistence to them. Things like housing-related inflation and services-related inflation that gave us more confidence that inflation was going to start coming in inside what the RBA was expecting, rather than having quite such a large increase in June as we had previously been expecting. So we had thought that the June quarter might be a bit of a big one, and that might have caused the RBA to sort of wait a bit before moving forward. But it's now become apparent, with 2 months of the quarter now in, that the downward momentum that we have been seeing in inflation, particularly on the housing and services side, is actually happening soon enough for that to affect the RBA's decisions earlier than previously expected.
So is there much risk then that RBA will wait until after that quarterly reading out on July 30 to cut?
I can't rule that out. They had said previously that they wanted to be cautious and predictable. I don't think moving again in July was what they thought they would be doing when they cut rates in May, but the facts have just moved a bit ahead of what they thought they would.
So where do you think interest rates will end up, and when will the next cuts come after the July move, if that so materialises?
Well, we're keeping the timing of the next 3 rate cuts after this one under review. A couple of weeks ago, I did put in 2 more rate cuts into my forecast. So the one that we're looking towards now, 1 more this year after that, and 2 next year. Now, it is possible, if inflation continues to surprise on the downside, that all of that happens a little bit earlier. But let's wait and see for what the RBA says after the July meeting and how the data come out from there.
Well, the RBA says it's well placed to act in a new era of, I suppose, Trump-sponsored global uncertainty. How will they act, and can they?
The RBA does have room to cut rates if they see things turning out a lot worse than they expected. I think we need to be a little bit realistic about the kinds of shocks that the Australian economy is facing, and the RBA is very well aware of this too. The initial tariff announcements were never going to stick. They were always an ambit claim that Trump was going to negotiate back from. That's how he operates. We are living in a more dangerous and multipolar world from a geopolitical perspective, but that means, more shocks, but not necessarily global conflagrations. So, people who are looking for a global financial crisis around every corner may find that actually what you see is episodes of volatility that are not so great. We're in a much more multipolar world. Australia is very keyed into the Chinese economy. Both the RBA and we at Westpac Economics expect that the Chinese economy will meet its growth target more or less, because the authorities there will do what is needed to achieve that. And so, there are a lot of buffers and margins of adjustment beyond just interest rates for the Australian economy to absorb whatever might come its way.
Luci Ellis, thank you so much.
Thanks very much, Alicia. Great to be here.
Virgin Australia's stock has soared after the company's long-awaited listing on the ASX. 5 years in the making, it's hoped this float will revive the lacklustre market for new public offerings. But the airline is hardly guaranteed all blue skies from here. Rihanna Whitson has the story.
It's the most highly anticipated public listing of the year.
Big smiles.
After several false starts, Virgin jets back onto the Australian share market.
3, 2, 1.
We're not short of capital, which is great. I think what it does is it transitions us to a new set of long-term shareholders.
News of the temporary closure of Qatari airspace threatened to overshadow Virgin's float, with 2 of its flights diverted.
It's been nerve-wracking. We just hope, keep our finger crossed for our safety.
If anybody doesn't want to travel, they're welcome to change their plans, or they can cancel, get a complete refund.
Qatar Airways became a major shareholder this year, bringing with it expanded access to international routes.
We think the impact on the share price has been minimal because one is that the immediate geopolitical tension usually are not long-lasting for the share market.
We hedge our fuel prices out for about 6 months so that we can ride through the big swings that happen day to day.
The airline's journey back to the ASX has been a long one. It collapsed into administration in 2020 at the height of the COVID-19 pandemic, which followed a brutal price war with Qantas.
Thousands of direct jobs, of course, on the line here.
Unable to secure a federal bailout package, US private investment firm Bain Capital bought the airline for $3.5 billion, killing off Virgin's budget offering Tiger.
It's a leaner airline than it was, say, 6 or 7 years ago. The lounges are more limited. It's product is really very much tailored to what they describe as the mid-market.
The float on the ASX raised $685 million for Bain Capital, which sold shares to investors at $2.90. By the end of the first day's trade, the stock was up more than 11% to $3.23 per share. Bain reduced its shareholding to 40%, while Qatar retains 23%. Virgin Management hold 7.8% and new investors own the rest. Fund manager June Bailu has bought some of the shares.
I think the share price is not overvalued. Virgin has been priced at an almost 30% discount to Qantas, whereas the actual earnings trajectory is actually higher than what Qantas is delivering.
I would never invest in an airline. I mean, it is a highly risky business.
Australia has one of the least competitive domestic aviation industries in the world, with customers left paying a high price to fly around the country. The big question is, will Virgin's relisting do anything to bring down the cost of airfares?
The only thing that is going to produce lower airfares is if demand slackens. If the economy slows, and it's not really showing a lot of signs of that at the moment.
Peter Harbison says freeing up airport slots to make way for competitors would also bring down fares.
The classic moves that are being taken by Qantas and by Virgin, essentially to mop up all the additional capacity so that there really isn't room for a new airline to come in.
Even a revitalised Rex Airlines won't break the Qantas-Virgin duopoly. Virgin customers are hoping for a miracle.
Prices, sometimes it's very dear. Maybe if they could come down a bit, that would be nice.
I think we could have gone to Bali for the same price, to be honest.
Where are you off to?
Just back home to Newcastle.
The success of Virgin's IPO still up in the air.
The monthly gas bill covers gas, but also the capital cost and maintenance of the pipeline network that delivers it. Those costs are paid by all consumers. But as Daniel Mercer reports, the growing trend towards electrification is leaving gas companies with a shrinking customer base to pick up the bill.
For more than half a century, the sight of a gas stove igniting has been synonymous with dinner time. But it's a changing picture because more and more Australians are getting off gas.
So we're starting to see with households that there is increasing electrification, and some jurisdictions like Victoria or the ACT have even got policies that would ban new connections to the gas network.
Gas pipeline owners recover their investments by spreading the costs across all customers. That customer base is forecast to fall steeply in the years ahead, posing a problem for the energy watchdog, which regulates the prices gas pipeline owners can charge.
When we find ourselves with a customer base that might be changing or shifting or shrinking through time, we find that we've got less tools available. And so from that perspective, it makes the job harder.
One of the tools available to regulators is an accounting trick called accelerated depreciation, where companies write down the value of the assets faster and consumers pick up the tab. The thing is, some energy companies are worried about the pace at which it's happening.
We think the transition is behind schedule, and if there's any sort of silver lining in that dark cloud is that perhaps that provides the opportunity to slow down the accelerated depreciation and take some pressure off the consumer bill.
So how's that chart looking then?
Claire Savage insists the regulator must balance the need to maintain that critical infrastructure with the needs of consumers.
When you look at totally what network businesses have asked of us over the last 5 years in terms of accelerated depreciation, it's more than $800 million that they've sought to have accelerated. And what we've approved is really only about half of that, so something like $440 million.
For their part, gas pipeline owners say they're not seeking to pass on all the risks to consumers, but need to recover what is often the huge upfront costs of buying or building gas pipelines.
We are talking about the recovery of the money that has been put into these infrastructure assets, and that is a separate question from the rates of return which you achieve when you invest in the asset. So there's return of capital and return on capital.
one thing everybody seems to agree, changes will be needed in the way gas pipelines are regulated.
The message on behalf of our customers would be, let's not run down the hill here and stumble. Let's walk down the hill and get it right.
At the moment, new customers don't pay the full costs of a new connection because it's subsidised by existing users. That's now being challenged.
How much should a connecting customer pay to the gas network? So what kind of contribution should a new customer make towards the assets that are being invested in on their behalf? We think that's a really interesting and very important question to get to the bottom of.
With questions about how to handle the switch away from gas flowing, the pressure for answers is sure to increase.
The Australian share market just managed a positive finish for the week. By Friday, the ASX 200 added 0.1%, the All Ords gained 0.25%. Kyle Rodda from Capital.com joined me from London. Kyle Rodda, welcome to Close of Business.
Thank you.
You're in London. There's been some big geopolitical developments this week, not to mention NATO members agreeing to boost defence spending. What's the mood there among London companies and investors?
Generally speaking, I mean, there's a lot of talk over here at the moment about how to boost productivity and how to kind of lift the UK economy out of this malaise that it's experienced over the last few years. There's fears about sort of stickiness in inflation and, of course, the post-Brexit effects of that. And there's also, sort of a very big discussion around distributional factors in the economy, wealth taxes in particular, and potential capital flight out of the country, and whether that will, on balance, be a good thing for the economy and, obviously allow for public finances to be improved, which has been a big issue over here over the last few years, or whether it's going to be something that actually deters investment and obviously, growth and productivity going forward.
Well, investors have welcomed plans by the US to remove the so-called revenge tax component of Donald Trump's big, beautiful bill.
Yeah, absolutely. And it's sort of the sense there that as well as trying to, reclaim revenues, as well as, finding ways to kind of tax assets that are offshore and held by, either governments via sort of central banks or maybe even, fund managers, sort of a wealth distribution of sorts as well, is that this element of the bill was included as kind of leverage to try and push forward with the Trump administration's trade agenda and their sort of desire to kind of, restructure US trade relations, more generally speaking. So the leverage is there. Clearly, the Trump administration has been trying to use it in trade negotiations to extract more favourable deals. And for the most part, because of the way that it could potentially impact the income from dividends, as well as the value of certain assets, US assets, it's considered a largely good thing at the margins for investors who won't have to necessarily tackle that. There won't be those sort of disruptions in the market. So again, it does seem largely that it was there in the first place to gain a little bit of leverage, as well as maybe find a way to save a few dollars here and there. But for the most part, that it's looking as though it might be removed is a positive overall for markets, notwithstanding, obviously, it's happening in the much bigger picture of hopefully just getting a trade deal done, which is the most important thing of all.
And Kyle, the US dollar touched a 3.5-year low this week. How's that playing out in currency markets?
Yeah, well, it's creating this kind of broad-based lift in every currency against the United States. Emerging market currencies are picking up. Obviously, the Aussie dollar, despite the fact the markets are pricing in another rate cut in July, is still above 65 cents. And, you're seeing a really big move in the euro and other areas as well, which is seeing either stubborn inflation or expectations of big fiscal impulse coming through in the not too distant future, partly because of military spending. But, there's a few things here, or really two things here that's to note. There's the cyclical factors weakening the US dollar and the structural factors. The cyclical, US trade policy is expected to weaken the economy. Interest rates will eventually be cut as a result. So that's weakening the currency. The structural story is around that credibility element again, that there's some doubts about the trustworthiness of the US government. There's a little bit of a crisis of confidence there. And this whole de-dollarization story is kind of, that's all wrapped up, I should say, in that de-dollarization story. So as a result, there's this weakness coming through the dollar and a very strong downtrend, it would seem, for now.
Kyle Rodda, thank you so much.
Thank you.
It's fine dining with a twist. A signature foie gras recipe of garlic, brandy and lab-grown meat. The novel meat replacement now has the approval of the food regulator in Australia, one of only a handful of countries worldwide to do so. The question for manufacturers is whether lab-made meat passes the taste test with consumers. Nadia Daly visited a factory where the product is made to find out.
A candle-lit dinner at what could be an inner-city restaurant. But what this diner is tucking into may surprise you.
As good as always, Kev. Thank you for that.
The meat on the plate wasn't once a live animal, it was grown in a lab.
Far from any farms, we're in a factory in the inner Sydney suburb of Alexandria where tiny meat cells will be grown into real meat that will then be formed into pâtés and other products that will find themselves onto the plates of diners in Singapore and likely soon Australia.
We look at all of the animals out there and we say, what would taste the most delicious? What would be the most nutritious for people?
First, cells are extracted from an animal, dead or alive, then they're multiplied in big tanks like this.
And what we do is we put the cells in a nutrient broth. That is essentially recreating a lot of the conditions in which cells grow in our body, in a way that's very similar to what you'd see in a brewery.
Eventually it forms a sludge-like paste which can then be turned into burgers, pâtés or foie gras.
And we were able to achieve a really delicate, kind of more velvety, silky texture.
Professor Dora Marinova from Curtin University says consumers will want to know how lab-grown meat will affect their health, while businesses are capitalising on environmental concerns.
There is more awareness of the high environmental footprint of the food choices that we have, and red meat has a very, very high associated greenhouse gas emissions. Lab-grown meat or cultured meat, we know that it requires much less land, but there are some questions asked around the use of energy because it's quite an energy-intensive process.
What's, say, the carbon footprint of meat grown here versus the same quantity, through conventional farming?
This facility, as it scales, has a lot of potential, even over the next year or so, to be roughly 50% the carbon emissions that the same equivalent amount of chicken to produce.
Aside from sustainability, the other question is around business viability.
I think the biggest issue is cost and scale. This is an expensive product to make. You need special equipment, you need expensive media. I've always said it'll remain a niche product, very different than a piece of steak. It doesn't have that same consistency, it doesn't have the same aroma, but it's an interesting new product.
Professor Paul Wood is a biotechnologist and barbecued meat enthusiast. He's tried lab-grown meat and was impressed with the product, though he says investor interest in the sector had recently fallen.
We're down probably at about 10% of the capital that was available a year or two ago. So the capital has dried up, and it's across the sort of alternative protein market in general, but cellular agriculture has suffered from that.
With the food regulator giving the product the green light, Vow's Chief Operating Officer is confident of the company's future, despite laying off 25% of staff earlier this year.
Within the first quarter of launching here in Australia, we should be able to sell at a profitable margin.
The food safety approval might seem like the biggest hurdle for this product in Australia, but the biggest question is, will consumers want to try it? Would you try lab-grown meat?
Yes, I would. As long as there's controls in place to make sure that the lab-grown meat's safe, why not?
Yeah, it's a bit weird. Like, meat's meat, why is it grown in a lab?
Yeah, I think I'd want to know more before I attempt it. I probably wouldn't, because I'm vegan.
If it's proven safe, I wouldn't mind giving it a go. Yeah, just out of curiosity and see how it compares to real meat.
Lab to plate could be on the menu within months.
From Daily Mirror copy boy to ABC Washington bureau chief and later the ABC's business editor, Peter Ryan's career has seen it all. But ill health has forced Peter to hang up the microphone and retire from the ABC. We look back at a career in journalism spanning 45 years.
These containers behind me left the Ranger uranium mine near Jabiru at about 2 this morning. Unlike much of rural Australia, Morwell had managed to avoid most recession-related pain.
When I got the phone call saying that I was going to Washington, I just was almost jumping out of my skin. I couldn't believe it.
The White House is reluctant to give the all clear until there's more evidence that Saddam Hussein has once again backed down.
The ABC's business editor Peter Ryan joins us now with all the details. Peter, take us through what you've uncovered.
Reporting economics and business and finance is perhaps the most challenging genre in the stable.
Let's go straight back to that breaking news this morning on the Commonwealth Bank now. Senior business correspondent Peter Ryan joins us now from Sydney.
And the winner is Peter Ryan.
Peter Ryan broke the news that AUSTRAC would allege that the Commonwealth Bank had allowed money launderers to exploit their deposit machines on 53,700 occasions.
The Financial Services Royal Commission begins in Melbourne this morning. Joining us to discuss how we got here and what's in store is the ABC senior business correspondent Peter Ryan.
Well, I'm pretty sure it's going to be ugly for the banks, and not just the banks, but insurance companies, super funds. It's not just a finance story. It's a front page socio-economic story that says a lot about our whole financial system. But a lot of nerves about the coronavirus.
Well, I've been on the phone to Medibank Private. They've confirmed the latest data done.
Thanks for getting up so early and coming in.
Oh, we need anything for news break.
We like that response. OK, are we going to have a recession or not?
Tough day for Alan Joyce, perhaps shrinking away a bit quieter than he had been expecting to.
Well, so many of the decisions taken around cabinet tables and boardroom tables were shaped and influenced in the first instance by Peter Ryan's authoritative voice. He has this remarkable ability to separate the consequential from the trivial, and if you couldn't pore over your own hundreds and hundreds of pages of economic analysis, you knew that Peter Ryan's report would be enough.
Peter Ryan, thanks again for your great analysis. Okay.
And that's all from Close of Business. I'm Alicia Barry. Thanks for watching.